Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitra Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I in Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And
Excellent.
while I'm sharing my screen, I wanted to make a note why we do this show every day. Will and I do the shows in the morning to try to help answer questions you guys may have about the Market Chameleon tools, data, or analytics. And if you want to come on a show and ask your question live, we put out a link to Zoom. It's on that live chat on YouTube. Click on it. It takes you over to YouTube. It takes you over to Zoom. Once you're in Zoom, there's a button at the bottom of your screen, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, everybody could hear you. But you could navigate as to what you're looking at. And ask your question directly. If you prefer to type in your question, you could also type that question into the live chat on YouTube. Will's watching it. He'll read it back to me. While we're waiting for questions to come in, we'll start out taking a look at the pre-market report, see what's trading in pre-market hours to get some insights on that. And as a reminder, we aren't doing the show tomorrow, Friday, or Monday. I'm going to be away in Miami. So we're going to take a break those days and then back on Tuesday.
Perfect.
Okay. So let's start out with the pre-market report. And then if we get questions, Will let me know. We'll take those. Okay. So the pre-market report, these are stocks that are trading in a pre-market hours. We have a list of our most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, I see 121 stocks made our percentage gainers list, 43 on the decliners. So from this perspective, right now we're lining up for a more bullish bias at the open. But if we take a look at this list, you could see that there are a lot of stocks in there that are small cap stocks. You see the market caps over here. There are stocks in there that could be preferred stocks. We have ETFs in there, leveraged ETFs, closed-end funds, really anything that is listed on a major U.S. exchange. If it's trading in a pre-market hours and meets our thresholds, it could make this list. So we want to take this list down to a smaller group of stocks to get a little bit more focused insight. And to do that, we could use the filters here above. I'm going to use this one in ETF. Click on this. We're going to drop it down and we'll get a list of ETFs to choose from. The top one is SPY, which is the S&P 500 ETF. Let's click on that. And you'll see that the list below got refiltered. And now it's filtered by stocks that are holdings in the SPY ETF. All right, now we're kind of looking at what's going on in the S&P 500 stocks. Here we do see 21 stocks made our percentage gainers list, 3 on the decliners. So again, from this perspective, this also looks like we're lining up for a more bullish bias at the open. Now, if we don't have questions or while we're waiting for questions to come in, I'll follow up on some of the things that we had questions left over and, maybe default to some questions we get over the email. But if you guys do have questions about a Market Chameleon tool or data or analytics or strategies, you're welcome to put that question in there and we'll discuss it. And while we are waiting, we did have a question yesterday. At the end of the day, we're talking about inflation. We're talking about market asset prices and dislocation. Somebody did bring up that the biggest market out there bigger than equities, bigger than the bond market is the currency exchange rate, right? The Forex currency exchange. And
Yeah, that was our favorite chameleon from Minnesota. Chuck brought that up. He's
yeah,
got a friend in Australia who only trades currencies, he said.
only trade currency. And the currencies could be also somewhat of a leading indicator for certain aspects. Tells you how strong or how confident people are in an individual economy. And when we look at the currencies and measure them, and I brought this up here. Let me go. This is a Bloomberg article. It's talking about the dollar slide. And I'm going to just come down here to this chart, and it shows you this is the dollar's strength versus a basket of international currencies that Bloomberg tracks. And you could see here that the dollar spiked up. And we pretty much had a strong dollar for a really long time. I would say, since World War II, the dollar strength has been, dominated the world because, we're basically entrenched in the entire world's financial system. The dollar is everywhere.
Yeah, we're the dollar's, the currency for the banking of the world, right? I mean, it's
the currency it's the currency for the banking of the world. And here in the US, we've been lucky because, we have US dollars, right? And when we track the US dollar, it's going to fluctuate, so it's never straight up. You could see here that right so far, we've got this benefit here. Fed's been raising interest rates. That tends to, make the dollar rise. Wherever you're seeing currencies raising interest rates makes that currency more desirable. So the dollar has been rising, but it did drop off here in the last quarter. And when the dollar declines in a situation where you're trying to fight inflation, it actually is going the opposite way of where you want it to do if you're trying to fight inflation, right? Because what happens is your currency declines. That means now it costs you more dollars to purchase goods from places that we're buying goods all over the world. And we are a net importer of goods. So if the dollar is declining, it costs more dollars to buy those goods. So it's considered inflationary, right? And this would be a lagging, because you're not going to feel it immediately. But if this continues, we will start seeing some inflationary pressures coming through in prices eventually if the dollar keeps declining. And of course, you could say certain instances that's good because if we export, it will be good for our exports. But right now, the number one thing on the Fed's mind, is to stabilize the currency and get inflation back to that 2% target. And the dollar decline does not help that situation. We run negative trade balances. We're net importer. We're big, we're consumption economy. So when that dollar declines, as far as inflation goes, that's not a positive direction. So I wanted to bring that up because somebody did mention the currencies yesterday, and it was in the context of our discussion on inflation. Another good point somebody brought out is, okay, if we're running these large deficits, we're at this point for next 10 years, the projection is that on the fiscal side, we're going to run deficits no matter what the economy does. It could be at full employment and inflation is moving up, but the projection is it does not matter. We're running deficits over $1 trillion. I forget what it is, like $1.5 trillion of deficits, which is inflationary. And then I forget who brought it up. Well, what about, productivity? If we have innovation and technology, and that technology is deflationary because it increases productivity, makes things more efficient. That's deflationary, that could offset the inflationary pressures coming out from other parts of the economy, particularly from our fiscal side.
Yeah, that was Rob who mentioned that actually at the end yesterday.
Yeah, and it's a good point. Yes, we've had in the, I would say, last, I don't know, 30 years almost, or 20 years for sure, we had explosive, technological revolution that has brought inflation down, made things more efficient. You had, first it started with computers, then with, networking and the internet, and then, all the things that were built on the internet. Definitely, technology has created deflationary pressures, and increased our standard of living. And the hope is that that will continue. And it does look like it will continue. However, we don't, in the short term, in the next year, we may not feel it yet, right? Because a lot of technologies out there, even that are sitting there right now and had the hope of, creating these efficiencies and creating the productivities, don't always materialize that way. And here I'm looking at let's just look over here, look at these stocks. I think this one is a 3D, right? SSY, this is 3D printing. I believe they're in 3D printing. Yeah, 3D printing, Stratosphere. For a long time, this was supposed to, 3D printing was a technology that could have been, multi-billion-dollar, business. You basically have a small manufacturing robots in your house that you could just, put in a code into your computer and print out, a set of dishes. Or you don't even have to go shopping anymore, right? You could just do it right from home. Dentists could create, teeth, just print them out right in their office. You don't have to send it out to a lab and have them recorded. Even the military said they could use it to create parts and stuff, but you could see sometimes it takes a long time. We don't feel as an economy that huge boom. It's like, what is growing faster? Is money growing faster, or is technology? And I'm seeing a lot of stocks in here that are, in the crypto space, right? And even that, the crypto space is promising, what do they call, Web 3.0. It's going to completely change the internet. And it might still happen, right? They were talking about the metaverse and stuff. So these are very positive things that are deflationary, probably in the long run. But as far as what's going on now with fighting inflation, because the Fed can't wait, right? They can't wait years, because if they wait 1 year, 2 years, 3 years, and the inflation gets out of control, then people lose confidence in the currency, and you don't have price stability. And if you don't have price stability, then it's much harder for these companies to exist and use the dollar as the basis for making decisions, right? Because any of these companies, when they do their planning and their investments and their projections and on return on investments and so forth, they need a stable currency. So in the short term, the Fed still is backed into a corner that, yeah, there are great technologies out there, and they're probably going to prove to be, things that are going to improve our standard of living and create deflationary pressures. But in the short term, the Fed still has to get that inflation under control because that's critical for our economy. Okay, so very good points, I think, and I just kind of wanted to follow up on that while we're waiting for questions to come in.
Yeah, that is interesting. Rob actually said at its heyday, the Model T Henry Ford plant made 100,000 autos yearly and employed over 100,000 people. Today, that same plant makes F-150s and employs about 3,200 people. And with all the robotics that are involved in production today, it makes 350,000 vehicles. So it's making 3 times the vehicles with, 3% of the employees, basically.
Yeah, and definitely that's the trend, and right now we have a lot of, we do have a lot of technology that looks very promising, and even like the AI, the Chat GPT, and now they have, other technologies like Chat GPT. I think there's like Perplexity and other ones out there that will increase productivity. I think that will increase people's productivity. I was using it. I started to use it. I'm like, oh wow, well this makes it much easier. Some of the things that it does and asks questions and helps you, assists you, and writing up definitions. It makes things much easier. So for sure, we have AI, we have with like voice recognition technologies and image recognition technologies and sensors, and then we have like at some point we're probably going to have cars that truly just drive you around, and you could just sit back and be chauffeured. These are exciting things, and I think yes, in the long term, that's positive for the market. But in the short term, the Fed still has to do its job its job is to maintain price stability through those bumpy roads, right? Because even with that technology, even with those innovations, the economy can still be bumpy, right? It could be choppy, and it needs to smooth it out. And that's why the Fed will, has to stay the course and bring that inflation target back to 2%. Even if it creates pain in sectors of the economy, it's still crucial, because the other way, it's going to be much worse if it doesn't. Another thing somebody brought up was tail risk. I think it had to do with the bank, right? So SVB Bank. When we talk about tail risk, I'll just use SPY as an example here. What is tail risk? I'm going to come out here, and when we look at implied volatilities, right? When we look at the implied vols, and is IV high or low, you tend to think of it as really the options are right around at the monies, right? The closest to that, the monies, because that's where the Vega is big, and that's where you're going to start hedging your deltas and trading your gamma, which is the Black-Scholes model. Implied volatilities are coming in from the Black-Scholes binomial model, and it's really if the stock is behaving in a certain way and moving in a normal distribution around the most current price. But when you come out here and you look at tail, options that are 20% out of the money, 15% out of the money, like in SPY, for example, you see here these risk options that are very cheap. That no longer has to do with a normal distribution curve or implied volatility. Those options you have to treat separately as that's something happening with very low probability. But when this happens, then the volatility doesn't moves violently. The stock will move violently through lots of it very quickly, and it's not going to trade at every penny on the way down. What will happen is that these would be like catastrophic puts, catastrophic event. Okay. And maybe on the way up, same thing can happen, especially in like a individual single stock, because the stock could get taken over, right? Like think about it. If a stock gets taken over for cash, right, 20% above, the implied volatility of that option was completely irrelevant, right? Because that's not implied volatility. That's not a volatility in the stock. That's just a stock going from one price, somebody takes it over, 20% higher, goes right to a different price. So the volatility of that option completely did not matter. That's why the tail risk, you have to look at it completely different. It's a different valuation of that option. So the implied volatility here, because I've even seen people who try to screen way out of the money puts, by implied volatility. I'm like, well, you're not even, at that point, you're just selling tail. It's either you think that this catastrophic event will not happen, that it's not going to be down 20%, or if it is, you're going to, blow out. And you have to treat those options differently, just like even options that are in a very short term that have a lot of gamma. You have to evaluate it differently than longer dated options that have a lot of vega. Okay. And to assess tail risk, it's very, very hard, because there are certain things you might be able to monitor to see if that tail risk is going up. But then there are certain things that are just unknown. It's just information coming in that you're not expecting, right? Like, a stock gets taken over. Well, you didn't know that. There's no way to anticipate that. There's no way, of having that information till it happens. And same thing to the downside. You don't know until something happens. But, one way maybe to help price tail risk is, here, I'll take Netflix because we'll have to do it like in an individual stock, is that some of these companies will tell you what their risks are, and maybe you can monitor those risks if they're going up or down. So I'll give you an example. Here's Netflix. I'm going to go over to the SEC filings in Netflix. I'm going to just click on this. And these are the annual reports. And in the annual reports, we'll go, let's see, let's get the full 10K. In the annual reports, you could go through them and they'll tell you their risk factors here, risk factors. You could read through the risk factors because this is what the company is starting to identify, risks that can adversely impact their business, right? Not just day-to-day business, but really adversely. Like, it could be a supply chain issue where there's a concentration of, material coming from one single entity. Well, that could be a big risk too, because let's say, you're buying semiconductor chips from this one place, and that's critical to your operations. And if that business, if they cut you off or something happens, then all of a sudden, it could be game over. You don't have another source to go to. And these are, if you're setting up a monitor for tail risks, it's good to go through and read through, what are they describing as things that could adversely impact. Maybe Netflix, who knows, maybe they have licenses that are going to expire and that they have to, renegotiate, or, a biotech company has patents that expire, or whatever it is. You want to go, if you're starting to look at tail risks and you're doing it in individual companies, it's very hard to price. You got to do your homework. And a starting point is at least go over what they identify themselves as risk that could adversely impact their business. So just wanted to bring that up because these are prior conversations we had this week.
That's interesting. I was thinking about Chuck's and everything that's mentioned. I'm thinking about tail risk, but I was thinking about Chuck's comment on the currencies, and the one stock that popped into my head was Virtue Financial.
Mm-hmm.
I wonder, like, how would you go and look at that and see where there may be, like, how do you view interest rates for a firm that makes markets? Like the stock looked, I looked at it. The stock looks like it's near its 52-week low. It's still paying a big dividend. It's VIRT, I think is the symbol.
I don't VIRT.
Yeah.
Virtue Financial. This one.
Yeah, they're a big market making firm.
Yeah. So really, if that is a good question, and probably you want to go in there again to find that out. A starting point would be go to their annual filing. Here's the full 10K, and start reading about the risk factors that they identify. The companies have to, whatever risk factors that they can identify, they have to list here, right? So you could see here right off the bat, what are their revenues and profitability? Depends on trading volume, volatility, retail participation. These are order flow, counterparty risk, clearinghouses, all this stuff. You should start looking at, because any of these things, if there's a drastic change, could impact that tail risk, and all of a sudden it could start going up. If they see a big issue, and that's what happened. I think with SVB Bank was that month over month they started to see deposits declining. Right, they saw more withdrawals than deposits. So all of a sudden they had to start selling assets, and that kind of led to that event. And I'm not even sure if they identified that. I think that there's a lawsuit that they didn't even identify that risk factor, that they knew about it, but they didn't identify it. And I think that there is a lawsuit by shareholders.
Yeah, I think even the regulators had identified it, maybe 6-9 months before in a review of their, processes, identify the risks to them. And, so.
Right, exactly. Yeah. So you want to, the people, if you're trading, tail risk is very hard. And when you trade it, you got to really do your homework, and especially if it's in an individual company, what can impact it. That's all of a sudden it's going to change, because it has nothing to do any longer with realized volatility versus implied volatility, right? If you're selling a 5-cent option or 10-cent option, it has nothing to do with trying to capture the difference between implied volatility and realized. You're really just selling a cheap catastrophic put. And if you're doing that, you really should do your homework and pay attention to any factor that could impact that company. And by the way, there are things you're not going to, no matter how much research, information's ongoing, so things can change like really quickly.
Yeah, well, that's an awesome piece of information, Dimitri. It's now the opening bell. It just went off. Thanks so much. Right. And a reminder to everyone, we will not have a show Thursday, Friday, or Monday. We'll be back next Tuesday. So everyone have a great couple trading days and a great weekend. Thanks, D.
Yep. Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys next week on Tuesday morning.
Tuesday. Have a great end of the week, everyone. Have a great vacation, D. You enjoy your time at the beach in beautiful Miami. Send some pictures to the Chameleon community. We'll see you later, buddy.
Yep. All right.